Pause the stacking for a sec. Drop the Java. Shut those tabs. Eye that spot price on your monitor. What's the handle? Near 71 bucks. Hushed, flat, comforting. That fiat figure is working hard. It keeps you suppressed. But here is the massive issue. If you trade charts, you likely tell yourself silver is consolidating, holding support, acting standard. But that ticker isn't real. It is a signal from a paper derivative system that no longer mirrors what is truly happening on the ground floor. While the West glues to screens, the physical scene in Asia is revealing a totally separate reality. In Tokyo, true silver metal you hold, not contracts that settle in fiat, is moving at values equivalent to roughly $130 per ounce. Not due to hype, not due to bets, because that is the true price stackers will pay to fully escape the fiat currency risk today. $71 on the spot chart, $130 in the real world. That spread isn't friction, it ain't tax, it ain't shipping. An 80+% premium isn't inefficiency, it is a fracture. When paper rates and physical costs detach like this, it implies the rig connecting them has totally snapped. The spot price is the cost of paper promises. The street price is the cost of certainty, and history is very clear on this point. When they diverge, paper always chases the real stuff, never the other way around. This is not the collapse just yet. This is the warning bell, and if you know what this gap really implies, you'll understand why it isn't closing, and why the next phase will catch the masses completely unprepared. If this has shifted your view of the rigged market, comment a 1 below and ensure you are subscribed. At this point, the skeptics start debating. I can already hear them. They say Japan has taxes. They say minting costs funds. They say shipping metal across the ocean isn't free. And on the surface, that sounds valid. Friction exists in every specific market. But friction does not cost 60 fiat dollars an ounce. Even if you stack every possible expense, fabrication, insurance, transport taxes, you might justify $10, maybe $15 if you're being generous. That still leaves a massive hole in the story. So the real question isn't why the price is higher in Tokyo. The real question is why the gap hasn't been closed today. In a functioning market, this would be the easiest arbitrage in the world. If silver is $71 in New York and $130 in Tokyo, the biggest banks on earth should be printing cash. They should be buying metal at paper price, shipping it east, and locking in risk-free profit by the ton. $30 million here, $40 million there. Banks do not ignore that kind of juicy spread. So why aren't they doing the trade? Because they simply can't. The arbitrage mechanism, the plumbing that connects paper contracts to physical delivery, is broken. Large industrial bars sitting in Western vaults cannot be converted into retail product fast enough. Refining capacity is limited. Secure transport is constrained. And most importantly, the silver in those vaults is far less liquid than the system pretends to be. If a major bank tried to pull tens of millions of ounces out of the exchange today, it wouldn't trigger a shipment. It would trigger a cash settlement. The system would force them to stay in paper. The bridge between the two worlds has clearly burned down. This is what bifurcation looks like. Two prices, two realities. In the paper world, silver is cheap and abundant. In the physical world, it's scarce and expensive. And the longer this persists, the more dangerous it becomes because it tells us something critical. The market is no longer self-correcting today. And when markets lose that function, they surely don't heal quietly. They simply snap. When people see this kind of divergence, they jump to the same conclusion: the bullion banks are finished. I see the headlines already. JP Morgan is trapped. The shorts are dead. This is the end. It's a satisfying narrative. It feels like justice. But it's also dangerous because it's incomplete. Yes, the banks are under pressure. Yes, they are bleeding out. But no, they are not about to collapse by tomorrow. Let's talk hard numbers, not emotion. The bullion banks hold a massive short position in silver through the futures market. On paper, it looks catastrophic. A move from $71 to $100 creates billions in mark-to-market losses. For a hedge fund, that would be fatal. For a systemically important bank, it's painful, but not lethal. These institutions are armored with fiat capital. Hundreds of billions in Tier 1 buffers exist for exactly this reason, to absorb shocks. A multi-billion-dollar loss ruins bonuses, destroys quarterly earnings, and gets traders fired. It does not automatically shut the doors. And there's another uncomfortable truth most people ignore. Banks are not gamblers, they are bookies. What looks like a naked short is often hedged elsewhere in opaque over-the-counter deals with miners and refiners. Losses in one pocket are frequently offset by gains in another. That doesn't make them innocent, it makes them durable now. What they are facing is not a solvency crisis, it's a liquidity squeeze. They need cash to meet margin calls while waiting for hedges to pay out. That distinction matters because liquidity problems buy time, and time is surely their greatest weapon. This is why betting on an overnight collapse is a mistake. If you assume the banks die tomorrow, you will over-leverage rush and get shaken out. The institutions can endure far longer than most retail traders can remain solvent. The war isn't ending here, it's changing shape. This is where expectations become truly dangerous. Many people believe that once the system is exposed, price action should explode straight up. A vertical candle. Instant justice. But markets don't move on morality. They move on control, and while the banks are losing control of direction, they still control the battlefield map. Direction is just physics. Control is strategy. The supply dynamics now demand higher prices. The shortage is real. The divergence is real. But the speed of that move is still being managed. The institutions still set margin rules. They still run the algorithms. They still own the casino. And their goal is simple: make this as painful as possible for anyone using heavy leverage. The first weapon is volatility. Expect violent swings, $5 up in the morning, $7 down by the close. Not because fundamentals changed, but because fear creates liquidity. Sudden drops force leverage traders to sell. Stops get hit. Positions are liquidated, and every forced sale helps the banks reduce net exposure. The second weapon is boredom. After a sharp rally, price will stall. Weeks of sideways action. No headlines, no excitement. This phase is designed to exhaust conviction. They want you distracted, chasing something else, convinced the move is truly over. Then without any warning, price jumps again. This stair-step pattern isn't random, it's deliberate. Rise, chop, smash, repeat. Each cycle removes weak hands while allowing institutions to reposition quietly. The banks aren't trying to kill the rally anymore. They are surely trying to survive it. That's why this isn't a sprint. It's a grind. A slow bleed where patience beats prediction. Those who expect fireworks will panic at the first engineered drop. Those who understand the process will recognize it for what it is, a managed, slow retreat. And while paper prices whip around violently, something else keeps happening in the background, something the banks cannot control, slow down, or even reverse. Or the physical supply continues to just disappear. That's the pressure point, and that's where this story turns from financial engineering into something far more dangerous now. Up to this point, everything we've discussed lives inside the financial system: balance sheets, derivatives, algorithms. But the real threat doesn't come from spreadsheets. It comes from physics, from metal that either exists where you need it or it doesn't. This is where the narrative really changes. While traders argue over charts, a structural supply shock has quietly taken shape. One that cannot be hedged, printed, or regulated away. China, the largest producer and consumer of refined silver on the planet, has shifted its priorities, not rhetorically, but legally. What's being described as export licensing is not a minor policy tweak. It's a gate. Smaller refiners, scrap processors, and trading houses, the entities that once fed excess silver into global markets, are now effectively locked inside domestic borders. Only state-aligned giants can export, and their mandate is no longer profit. It's purely security. China burns through way more silver than they can dig up. Solar tech eats massive piles, and newer panels guzzle even more metal per watt. That huge internal deficit signals one stark reality: zero surplus for export. Every single ounce is claimed before it even exits the refinery gates. This isn't just a blip, it is deeply structural. For decades, the West leaned on Asian stacks to fix shortages. That safety valve is totally gone. When global markets lose a key supplier, prices don't just shift slowly, they completely rewire. Now, industry players aren't buying just in time, they are buying just in case. The hoarding starts, safety stockpiles replace efficiency. Once that panic buying kicks in, it feeds on itself. Banks rig paper markets, but they can't force refineries to export, they can't print real bars, and they can't reverse heavy geopolitical moves with leverage. This is the one variable they can't control. It is why pressure keeps building up no matter what the rig charts say. Because when real supply stops flowing, price stops being negotiable. When folks talk silver availability, they usually point to the wrong number. They view total inventory and claim there is plenty of metal. That illusion is totally deliberate. The real story lies deeper in a category most investors never even bother to try and understand. It is registered inventory. This is the silver that truly matters, not silver that meets purity standards, not silver that exists somewhere in a vault. Registered silver is the metal that is legally available to settle contracts. It is the absolute last line of defense between the paper market and failure. And that line is getting dangerously thin. Right now, the registered silver sitting inside the system represents less than 2 weeks of global consumption. Not months, not years, just mere days. Everything else, the so-called eligible silver, belongs to private owners under no obligation to sell. The banks cannot touch it. They can't commandeer it. They can only hope someone strictly volunteers. But ask yourself one honest question. If you owned silver and saw the real-world price climbing far above the paper quote, would you hand it over at a discount? Or would you just wait? That is why the eligible pile is frozen. It exists, but it doesn't circulate, which means the entire pricing system is balanced on a shrinking pool of deliverable metal that is being drained every single day. This is not accidental. It is mathematical. When a commodity is priced artificially low, demand doesn't disappear, it accelerates. Buyers rush to the cheapest source on earth, and right now that source is the paper exchange itself. Standing for delivery is no longer an act of speculation, it is an act of rational purchasing. And every ounce that leaves tightens the clock tick. This is the countdown most people never see. Not a timer on a chart, but a physical limit. When that registered number approaches 0, the system doesn't adjust. It fully protects itself. And protection in this case means just one thing. It implies cash settlement. When most people hear the word default, they imagine chaos, markets crashing, headlines screaming. That is not how modern financial systems fail. They fail quietly behind legal language and dull procedural adjustments. If registered inventory runs too low, the exchange won't panic. It simply invokes the rules. Physical delivery gets temporarily suspended, logistics are blamed, market stability is cited, force majeure is declared. On paper, everything is orderly. In reality, it is the exact moment the promise breaks. Instead of metal, contract holders receive cash, the official spot price, the very currency they were trying to escape. And by the time that happens, the real market has already moved well on. This is the trap. A cash settlement isn't a refund, it is a denial of access. While you are handed paper at $71, the physical price gaps to levels that no longer care about charts or fairness. You didn't lose money on paper. You lost raw purchasing power. That is why this isn't just a pricing event. It is a separation event. Those holding promises stay inside the system. Those holding metal step right outside it. And this is where pure psychology takes over. The moment headlines hint that delivery might be constrained, behavior changes instantly. Industrial users scramble. Funds that never cared about physical metal suddenly demand it. Inventory doesn't drain slowly anymore, it simply vanishes. We've seen this before in smaller markets. Nickel, palladium. When confidence breaks, the exit is not wide enough for everyone, and the silver market is far smaller than most people even realize. The irony is brutal. The cheaper the paper price stays, the faster the physical disappears. Suppression accelerates its own imminent failure. This isn't the end yet. But once cash settlement becomes even a possibility, the game changes permanently. Because no one who understands this will voluntarily stay trapped on the wrong side of that hard line. And that brings us to the most important question of them all. What should you actually do then? This is where most people make their biggest mistake. They confuse urgency with panic. They see headlines about triple-digit prices overseas and feel compelled to act immediately at any cost. That instinct is understandable, and it is exactly what destroys your capital. Paying an extreme premium is not strategy, it is pure fear. When buyers in Tokyo pay 80% over spot, they are not making an investment decision. They are making an escape decision. Their currency is collapsing, and price no longer matters. You are not in that position, and that gives you a real advantage. Your edge exists because the manipulation still exists there. The banks are holding the paper price down to protect themselves. In doing so, they are subsidizing your entry. Every time the spot price is pushed lower, the physical buyer outside the panic zone gets a discount on true reality. Think about the math. $71 plus a modest physical premium puts real metal in your hands for far less than what the global market is already signaling. Same element, same utility, same scarcity, different price for it just now. This opportunity only exists in one narrow window before the system admits the full truth. And here is the rule that cannot be bent. This strategy only works if you hold physical metal. Not paper, not ETFs, not unallocated accounts. Those are promises inside a system that is already preparing its many exit clauses. Unallocated silver is not silver. It is a liability. You are an unsecured creditor lending capital to an institution that is structurally short the asset you think you own, when stress peaks that claim is settled in cash, not real metal. Physical ownership removes counterparty risk completely. No margin calls, no rule changes, no forced settlement. A bar in your possession does not care what the exchange really declares. The premium you pay is not a fee. It is insurance against being trapped on the wrong side of the system when the rules actually change. This market is not rewarding clever trading. It is rewarding true, correct positioning. And that positioning becomes critical as we approach the final endgame phase. Most stackers mistakenly think the COMEX breaks in a single dramatic moment. One green candle, one headline, one overnight gap up. But fiat systems don't die that fast when the central banks are desperate to survive. What follows now is a grind. Spot prices will move higher but never cleanly. Sharp rallies will follow sudden tamps. Margin requirements will rise without warning. Volatility is weaponized to exhaust anyone relying on leverage or short-term bets. This isn't randomness, it's pure filtration. Every spike shakes out the tourists. Every tamp transfers ounces from weak hands to the strong stackers. Meanwhile, the physical market keeps tightening. Vaults don't refill, supply doesn't magically appear. Industrial usage doesn't slow just because the spot price action is rigged. The divergence widens quietly, even on days when the paper chart looks ugly. This is the phase where the news flips constantly. 1 week the squeeze is over, the next it's unstoppable. That confusion is intentional. Confused paper traders make mistakes. Real stackers just accumulate. Eventually, the COMEX breaks. Maybe it's registered inventory, maybe it's delivery defaults, maybe it's war. The trigger won't matter, only your stack will. When the fiat system finally concedes the price reset, won't ask for any permission. By then, paper spot targets won't matter. We won't be debating $71 versus $80. We will be debating availability, and physical scarcity doesn't negotiate. Those holding silver will not need to sell. Those without it won't be able to buy. That's how repricing actually happens, not through graphs, but through exclusion. The question isn't if the manipulation ends, it is whether you hold on without being shaken out before it breaks. Because once this fiat collapse completes, there is no reset. There is only true price discovery. Chapter 10, Stacking Strategy, the Lesson and Final Call. Everything leads to one unavoidable conclusion. This is not a trading event, it's a monetary shift. Silver isn't just mispriced. It is breaking under the weight of reality. When fiat systems break, they don't reward speed or cleverness. They reward preparation and physical holding. The core lesson is simple, yet uncomfortable. Paper contracts are fragile. They depend on rules, trust, and logistics. Physical silver depends on none of that. When stress rises, the exchange always protects itself first, not the retail participant. This is why the winning strategy isn't leverage. It isn't timing the perfect bottom. It is not chasing headlines or waiting for news that comes too late. The strategy is stacking before the rules change and then having the discipline to sit through the volatility. Ignore the FUD. Volatility is not a signal to sell, it's a signal of stress. Focus on ounces, not fiat quotes. Prices will move violently, but scarcity moves in only one direction. When supply contracts and demand becomes inelastic, repricing is not a possibility, it is a requirement. The biggest mistake you can make is believing this window stays open forever. It won't. Once the COMEX is forced to acknowledge physical reality, the premiums disappear. There is no second chance at these same terms. History doesn't repeat gently. It compresses outcomes. Those who stacked early look calm. Those who waited feel blindsided. So here's the final takeaway. Do not buy FOMO. Do not chase fear. Use the distortion while it exists. Hold what cannot be printed, rehypothecated, or settled away. When the dust clears, charts won't matter. Ownership will. If this breakdown gave you clarity, make sure you subscribe, like, and share this with someone who still trusts the fake spot price. And if you made it this far, comment 1 below. It tells me you are thinking long-term, not reacting to the short-term. The system is failing. The strategy is set. See you on the other side of the reset.